Hey there, and welcome to Reverse Mortgages Explained. This is not going to be a 3 or 5 or 15-minute video. What I'm going to do in this one is I'm going to go all the way through what reverse mortgages are, how people are utilizing them, some FAQs, some myths, proprietary reverse mortgages versus the regular traditional HECM reverse mortgage, all of that stuff. And the reason why I'm doing this in such depth is I've done reverses since 2008. By the way, my name is Jason Eichmiller. I'll introduce myself in a minute or two, but I keep getting questions, and a lot of times the questions have misinformation in them. For example, who gets my house after I pass away? Well, of course, your kids do, but a lot of times people don't know it. So I figured that this is a good time to just kick back and teach you now I'm not going to turn you into a reverse mortgageologist. I don't think you want that. But what I do want to do is give you a very solid knowledge base on reverse mortgages. So if you're looking at one for yourself, for a loved one, or for a client, you kind of have an idea of how it works. And if your scenario matches up with some of the scenarios we're going to talk about, and by the way, we're going to go into real client scenarios. So we'll do case studies and we'll look at what caused people to want to get a reverse mortgage and how the reverse mortgage ended up working for them in the end, which is really, really neat. And I don't do that too often. So very, very excited about this. So I actually have got my daughter's Taylor Swift water cup here. And this is going to be a lot and a lot of talking. I even have my good old Flanagan's backup water cup. So if you're ready, then I'm ready and we can get onto it. So here is we'll be going through a slideshow. This is a not so great picture of me, but reverse mortgages explained. We're going to do the slideshow and I'm just going to talk our way through it here. So what you're going to learn today, and by the way, I'm very, very excited to teach this to you. I think it's long awaited. So hope you're as excited as me. So first things, how today's seniors are using their home equity to create a more comfortable retirement. And I guess I should also say why today's seniors need to use their home equity to empower their retirement. How reverse mortgages work, including specific details and case studies, how they can take their money, the differences between the HECM which is the government FHA reverse mortgage, and the proprietary reverse, and when to use each. I'm not going to go too deep in it. Maybe I will. Maybe you know what? I'll give you a scenario, kind of comparing and contrasting the fees and who should do what. There are some new reverse mortgage programs that have come out recently. We'll touch on those. And this is something that nobody ever talks about, but we're going to. The reverse mortgage fees. So we'll go over, because that's a hot button too. Hey, what are the fees involved with reverse mortgages? So we'll go over those as well, but that'll be towards the very end of this presentation. Now, one thing also, I am going to timestamp some of this information. So if you're looking for the very basics on reverse mortgages, you can that'll be towards the beginning, and the specific stuff is going to be towards the end, but I'll try to have timestamps up here. I'm not an expert on PowerPoint. I'm not an expert on these presentations. I am an expert on reverse mortgages. So I'm going to give it my best shot to kind of direct you to where you should go in this video. By the way, my name, again, I'll just introduce myself real quick. My name is Jason Eichmiller. I've been doing reverses since 2008. I own this channel, Reverse Mortgage Reality, and I'm a reverse mortgage broker. What that means in English is I work with all the major reverse mortgage companies, besides one or two that just do a terrible job. I'm not going to call them out here. Maybe I will a little later. But yeah, my only goal is to make sure that this helps you, and it helps you in the best way that it can possibly assist. So here's a couple testimonials. One was from Chuck and Millie. The other one's from Mike. If you want to read them through, then go ahead and push pause on this video, but we're just going to move on. A couple more. This is Henry. He did a reverse with me over the summer. Oscar, great guy. Nadine and Mike, they were terrific to work with. I've got tons of these testimonials, emails, videos on the website, Reverse Mortgage Reality. By the way, again, if you want to read these in depth, you can either go to www.reversequotes.com, or you can just push, if you want to read these ones, just push pause and you can read through them. If you do go to Reverse Quotes, you can see interviews with some of the clients that I've helped. Down here towards the bottom, this is actually the daughter. She was looking for a reverse mortgage for her mom, introduced her mom to me. I think we knocked it out of the park, did a great job for her, and the daughter is incredibly happy. So this is my family. It's my wife, Bridget, me, Alyssa is my 13-year-old, Jason's my 11-year-old, Molly's my 9-year-old. A couple more pictures of us. Love them so much. They're absolutely wonderful, wonderful people. And this here is the website, reversequotes.com. You can go there. So there's a few ways to reach me. Number one, you can kind of see all the information scrolling below, and it'll continue to. So you can call me if you want to speak directly. If you want to email me a question, feel free. Or you can go to the website, reversequotes.com. If you're on desktop, on the right, you'll be able to input your information to schedule a call. If you're on mobile, then you'll have to kind of scroll down a little bit to input your information. And then below all that is where this stuff is, the testimonials and the videos that we've done. Okay, enough about me. You get it. If you've seen these videos before, you know who I am. But let's go over the very, very basics about reverse mortgages. We're just going to do it in a slide or two. And if you do have questions, if I'm not being clear enough, because I do this, I probably describe reverse mortgages 10 times a day. Go ahead and just type your question in below. And I'm one of the rare people who actually looks at all my comments and questions, and I will answer them on this video or below this video in the comments section. So what's a reverse mortgage? A reverse mortgage is a program that's available for seniors who are 55 and older. By the way, you'll see this in part 1 and part 2. I'm just kind of giving you my description as I talk through it. Might not match up directly to the talking points. Excuse me. So what it does is it allows you to take part of your home's value out in tax-free cash without being required to make a monthly payment on the money you get. Although you can if you want to. That's something that people don't understand. So if you want to occasionally make a payment or make a monthly payment, however you want, the best way to think about a reverse, I think, is it's just a regular mortgage. It's the same thing. We give you some money, lean it up against your house. You stay on the deed. You have full ownership. But instead, the difference between a reverse and a regular mortgage, or one of the big ones, is that instead of being required to make monthly payments on it, you decide. You say, hey, yeah, I'll make some payments. I'll pay whatever I want. Or you say, you know what? I don't want to make any monthly payments on it. The cash is better in my pocket because I'm a senior. I'm on fixed income. I need a reverse for either cash flow purposes or maybe to create a safety net or just to live retirement easier. Like this, a lot of the folks that I'm helping, they've got $1 million or so in assets, and they realize, and I'll post a study in a little bit, but they realize that to continue to live as well as they've been living, they're a little concerned that their money might not last because they have a great lifestyle. So they want to use their house to unlock some of that money. So anyway, you stay on title, you make payments if you want to. The minimum age is 55 for Proprietary, 62 for HECM. And the way you can get your money is you can get all of it up front. Well, if you get a HECM, you get about 60% up front. You can get monthly income. You can get a line of credit that actually grows tax-free. We'll go over that. We'll actually go over an amortization schedule a little bit farther down the video. You can get a combination of that money. And the only requirement that they have is that anything that's owed on your house gets paid off before we give you some money. So if you have a mortgage on the house, we pay off that mortgage. Then you can use the additional money and you can decide, hey, I want to do it in monthly income, or I just want to leave it in a line of credit. And yes, qualification is based on your age and your home value, which everybody knows, but also interest rates. And I've got a bunch of videos where we talk about how interest rates impact reverses. If you'd like to see those, then just comment below and I'll post the link to it if you'd like to see those interest rate videos. So more on reverses. they really are, they're God, sounds like I'm being dramatic, but they really are. These are game changers. These will actually change your retirement. If you want to live in your home, but you could use some more cash flow, or you need to create a safety net for yourself, then reverses work very, very well. Seniors can actually, you can use your home, you can actually use a reverse mortgage to buy a home, to buy your forever home. We'll go over an example on that a little bit later. Also, use it to eliminate a mortgage payment. Got a guy right now who's doing a reverse, actually a second reverse, to fund a business. By the way, if you're interested in a second reverse, just comment that below. I don't spend too much time talking about it on this overview, but it's really neat. That way, if you have a low rate first mortgage and you're okay with keeping it, but you want some extra cash, you can do a reverse second. You can use it to pay for home health care. Got an example. I do lots of home health care cases with reverse mortgages, help the grandkids, and just enjoy life. So I've got a bunch of examples coming up later, but just to get you thinking a little bit about how you can use a reverse. Those are some ideas. So specific examples of seniors using reverse mortgages are coming up soon. We're going to have that a little bit later in the video. Excuse me. But first, why are reverse mortgages so popular right now in today's economy? You could probably tell me, but I'm going to tell you what I think and what my clients have told me. So first thing is, if you don't have investments, then this is all the more real for you. But if you do have investments, stick around. If you don't have investments, stick around as well. So first of all, over the past couple of years, the stock market, individual stocks, investments with this economy, investments have crashed. Now they are coming up a little bit right now as I'm speaking, but they're still down. So in retirement, I mean, that's why we create 401ks and IRAs, and we save all this money, because we need to live off of our assets. We need to live off of these investments that we've gotten, that we've accumulated over the years. So a lot of those are down, and they've dropped, and they're still down. And it's really, really tough. And again, if you're in this situation, you can tell me just as well as I can tell you. If your investments are down, then you have to take from them while they're down. And then if you have taxes, it becomes a really, really big deal. And there's a vocabulary term that we use for this, and it's called sequence of return risk. And what it really means, I'm not going to get too scientific into it, but again, big picture, if you're going through this, you understand. It's basically, if your investments have dropped, you're taking too much out of them. And now you and your financial advisor, you're both worried that your money might not last as long as you're going to last. For example, if $500,000 drops 10%, then it's just 450. Now you're withdrawing when you're taking down and it's dropped 10%, then your money goes faster. And then if you have taxes, which we call qualified money in the business, then your money goes down even faster. And it's really scary. And if it keeps your financial advisor up at night, I'll tell you the amount of folks who have reached out to me and told me that, hey, they're just doing this reverse so that they can sleep well at night, so they know that they're not going to outlive their money. I mean, I could recount so many instances and so many folks that I've helped in that situation. So let's talk about inflation versus fixed income very, very quickly. So Social Security in 2023, the Social Security Administration increased it by over 8%. Now it's just upping to 3.2% in 2024. That is, and you know your budget, and if you'd like a financial worksheet, then just comment below, say something like financial worksheet, and I'll shoot it over to you. But do you think is 3%, a 3% Social Security increase, is that enough? Your groceries, your gas, your homeowner's insurance, everything, the price of just about everything is increasing so drastically. Oh, and Social Security is giving you 3% more. Is that enough? Really? I don't think so either. So here's a study real quick. It was done by a life insurance annuity kind of financial advisor firm called Allianz. And they've done these studies over the years, but basically how a long life can impact retirement savings. And what they found is, they did this in 2022. And they found that 48%, just to the bottom of this this little slide. 48% of Americans say they're worried that they're going to outlive their money, and 42% say there is no way they can afford to live decades in retirement. And again, it's due to, what's it due to? It's due to inflation, right? It's due to fixed income going nowhere. It's due to the stock market dropping, right? You have less money than before. And if you're on fixed income, by the way, that's that 42%. If you're on fixed income, then that Social Security, that pension has to pay for everything. This is, by the way, so far, this is doom and gloom. And I'm not trying to be that way. I'm a very positive person. So let's do some good news here. So home values, home equity. For the majority of seniors, well, first of all, your home might be your biggest asset. I get some folks who have more money in their investments than their home, but a good number. The home is the biggest asset. But you can see that since COVID in 2020, home values have drastically appreciated. And in fact, higher interest rates, which we're all in this world right now with high interest rates, they still haven't. Yes, home values aren't, in some areas, they're not worth as much as they were, say, 6 months ago, but values are still so high. So at one time, and yeah, in red, look at your home value now versus 5 years ago. Look at that appreciation. It's pretty awesome. So on one hand, everything's down. Investments are down. Social fixed income is staying the same. Expenses are up, which points a very bleak picture. But at least now you have your home, and your home's worth a lot more, which means in some cases, circling back to the reverse, you can take a reverse mortgage to better afford retirement, right? CPAs who I train, financial advisors I train. In an hour and a half, I'm going on an interview with a financial advisor, talking about using home equity. Hopefully I'm done this by then. I think I will be. But you can stop taking your assets when the market's down. Remember that sequence of return risk. Get an extra branch on your retirement money tree. Normally we do that with a reverse mortgage line of credit. It's just extra cash that you can take out of your home that you don't get taxed on. It actually grows and gets bigger when you don't use it, which is really neat. Pay for home health care, eliminate high interest bills, credit cards. I have a lot of folks who are calling me to use a reverse. A lot of times that actually comes into the second reverse mortgage, where again, they have a mortgage that's at 2 or 3%, but their credit cards are out of control. So they're just tapping their house for the second to eliminate those credit cards and high interest bills. Purchase your forever home with no mortgage payment. Again, that's one of my favorite programs, the reverse mortgage purchase. So you get it. These are some of the things that you can use your newfound home equity to do. Now, I told you before that we're going to look at examples, so let's look at some examples. So let's see what seniors are doing. So I've got 1, 2, 3, 4, 5 examples here. I could have done more, but in the interest of saving time, if you're in this scenario, great. I've helped tons of people in these scenarios. If not, then give me a shout. Phone numbers below, or write a comment below, and I've helped people in other situations as well. There you go, right below, outside the box ideas. So feel free to reach out. I always find in my life, asking questions is always free. Reaching out is always free. Trying to get help is always free. Worst case is you can't do it, or it's not smart. At least you learned something. So anyway, let's go through some scenarios. The first one is we're going to talk about Margaret, her journey, and it's all about paying down debt for Margaret. So she's a 79-year-old widow who has a $950,000 home and just under a $300,000 mortgage. And Margaret loves her home, but that payment of $3,400 on her mortgage was too high to keep going. Her fixed income is just $4,700 a month. She also has $37,000 in credit cards with a minimum payment of 2%, $740 a month. Her taxes, her homeowner's insurance is $572 a month. She has her grocery bill, and she has her Medicare, those expenses. She has her prescriptions. Life ain't cheap for Margaret. She's having a really, really tough time sustaining. In fact, every month she's taking more and more money out of her assets. So how did this reverse mortgage work for her? Wonderful, wonderful woman, by the way. So Margaret's new life. Again, I sound dramatic when I say new life, but it really is. This program changes people's lives. When you can sleep through the night without worrying about your money, it's an absolutely beautiful feeling. So let's talk about Margaret. Okay. So number one, as you know, the reverse mortgage eliminated her mortgage payment. So let's look at what her mortgage payment was again. $3,400. Boom. Gone. Okay. Then she got $41,000 of tax-free cash, 37 of which paid off her credit cards. Then she got another line of credit of 41 that grows. It's actually going to grow tax-free over the years. Her savings, and again, we'll look at how the line of credit grows a little bit later on in this video in a different example. But her savings are over $4,000 a month, which means Margaret now can, again, I keep saying sleep well at night, but that's because my clients, it's what they tell me over and over and over again. When you go from where they were to where they are, man, you just taking that weight off your shoulders it's so profound. It's such an amazing change. So she's financially stable, and I'm so happy for her. And like everybody I helped, I feel blessed to be the guy with the program. Not that I'm doing any magic or anything, but this program is what does it. So that was Margaret. Now let's talk about Anne's journey through home healthcare. So Anne, we just closed her a couple months ago, actually. She wants to live in her condo forever. She's 93 years old. She's a widow as well. Owns an $804,000 condo, has no mortgage on it. She's very, very sharp mentally, wonderful person, but her body's breaking down. She's getting home health care, by the way, 24/7 roundabout care. And she only has at the point when we spoke, she only had 3 months of cash for her home health care remaining. So she wanted to be in her condo forever, but she needed help. And this is one of the reverses where her kids actually reached out to me asking for help. So we went through and everything looked good. Obviously, she had the equity. Her credit score was terrific, but we ran into a problem. Her condo, and if you own a condo, if you try to get a reverse mortgage, you're probably familiar with this, but her condo doesn't qualify for a regular FHA reverse mortgage. Couldn't qualify. We actually tried and it didn't work. So you can see the bullet point below. Getting a condo approved for the FHA does take forever, takes months, and 90% of the time it fails. There's something, if they're not approved for the FHA, it's very rare that they're going to do all the legwork, and then sometimes their insurance fails. It's really, really hard to do. But that doesn't change this situation for Anne because she desperately needed help. So we were stuck between a rock and a hard place. What did we do? And could we help her? And of course we could, because it's in this example. I wouldn't write an example. Yeah, we wanted to help her, but we couldn't. So Anne's homeless or in a nursing home. No, we helped her. So what we did was we found a proprietary reverse. Remember in the beginning, we're going to talk about the difference between proprietaries and HECMs. So we found a proprietary reverse mortgage that actually approved the condo within 1 week. Imagine that. Anne got almost half the value of her home in tax-free cash. So she cashed out about just under half of it. Obviously, as you know, she doesn't have to make mortgage payments on the money that she got. And her son, Paul, and her daughter, they're just so happy for her. I am too. Like, we're all ecstatic that this came together and that she's going to be able to live there for the rest of her life. We projected out kind of based on her health, the money that she was getting and the cost of the home health care. And she really is going to be able to live there for the rest of her life, which just makes me, what do they say? That's the bee's knees. It makes me so happy. So that was Anne's story. Now that's 2 down. Let's take a look at the reverse mortgage line of credit, the retirement safety net. We'll talk about Mike and Ellen. All right. So Mike and Ellen, they're in their early 70s. And they're free and clear on their $1 million house, actually $1.05 million. So no mortgage, early 70s, $1 million house. Their investments have dropped drastically, but remember that sequence of return we were talking about a few minutes ago. They're still having to draw from down assets to survive. And at this rate, Mike's got a good financial advisor, and he's worried that their savings are going to run out. Again, the up in the middle of the night worrying about your money. So let's talk about the reverse mortgage line of credit, and let's see what it does for Mike and Ellen. So here is an amortization table for Mike and Ellen. Okay. So you can see here, and obviously interest rates and specific numbers are going to depend on when you get this. So take this as a 10,000 foot level, not as an exact. It was exact for Mike and Ellen, but it's not going to be exact for you. So $1.05 million house, line of credit starts at 360. 360 turns to 390, to 426, to 466, to 509, to 556, to 6. 10 years in, if they don't, so I'm going to give you the truth in this because it looks great. If they don't touch any money from their line of credit in 10 years, if the interest rate stay the same, and they won't, they're going to go up and then they're going to go back down, but we can't predict that. So if rates stay the same, then in 10 years, we know that the line of credit's going to be 700. It's basically double. 15 years, 1.1. 20 years, 1.7 something. That's pretty neat. Now, what I expect Mike and Ellen to do is, so yes, it's growing at a little bit over 8.5 or a little under 8.5 per year. It doubles just about 9 to 10 years. And yes, you saw what happens if they don't touch it for 20 years. It might be more money than their house is worth in 20 years. Maybe not. Who knows where house values are going to be. But if it is more money than the house is worth in 20 years, they can take it all and they don't get penalized and they don't get taxed. It's absolutely wild. But in this case also, so just being realistic, because they are having to take out of their investments to survive, they probably are going to tap this line of credit. They're going to take a little here and a little there. What a lot of financial advisors recommend is when your investments are down, then you take out of your home equity. You take from the reverse mortgage line of credit. And when the investments are up, you take from the investments. So you've got kind of two things that you're balancing at the same time. So yes, when you take from the line of credit, it's not going to grow as crazy because it's only the money that's remaining. But still, let's say after 10 years, what if it's not 867? Let's say it's 567. And you're preserving your assets. That's pretty, as they say, that's pretty dang okay. Yes, as you can tell, as you can see, the line of credit is a game changer for Mike and Ellen and so many of my clients who get the reverse mortgage line of credit. So that we're kind of breezing through it, but I think the reverse mortgage line of credit, it's so unique and it's one of the most powerful characteristics of the reverse mortgage. So if you want to learn more about that, if you have a lot of equity in your home and you want to see what a line of credit can do for you, definitely reach out, or you can always again comment below and I'll answer your comment, but it'll take a little bit of information back and forth to draw you up a kind of projections. And by the way, that's what we do. So I can easily, with a couple of data points, about a 15-minute phone call, I can craft one of these amortization tables for you so you can see for yourself. Okay, let's talk about the HECM for purchase, or the reverse for purchase if we're using a proprietary, buying a home. So Joe and Beth, they had a wonderful home. I've seen pictures. It's gorgeous. But they're getting old enough and their health is getting to a point where they needed to downsize from 2 stories to 1. They just weren't able to get up the stairs, and they're in their 60s. So what about 70s and 80s? Normally with this whole age thing, Father Time is undefeated and it's not going to get better. So they needed to downsize. They were still working. They planned to retire. So they didn't want a mortgage payment, but they also, obviously, home values are so high right now. They didn't want to pay full price for a home in today's market. Furthermore, or finally, this might be their last move. They wanted it to be. They don't want to move. Moving is so stressful if you're in your 20s, 30s, 40s, or 50s. But when you're 60s, 70s, 80s, moving becomes entirely very, 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 very stressful. So we had to get this right. And this is how the reverse mortgage for purchase worked for them. So here's what they found. Remember, they had to downsize. They found a rancher for $650,000. In this world right now, by the way, higher interest rates mean that loan sizes are smaller, so they did have to pay a little bit more than they would have had to pay a couple years ago. The down payment was $475,000, which means, though, what's 650 minus 475? $175,000. He kept $175,000 in his savings. Joe doesn't have a mortgage payment, and they're happy where they are at. So they're in their rancher, so they're going to be able to live there for the rest of their lives. They've got more cash in their piggy bank because they didn't have to put it all down, and they don't have a mortgage payment, which means that they can comfortably retire. This worked absolutely perfect for them. So now we come to outside the box ideas, right? The examples that I gave you before, those are pretty common. Do a lot of them. You might see if there's other folks on YouTube talking about reverse mortgages, they might touch on those scenarios. But let's take this a step farther and let's see what reverse mortgages can really do for some different situations. Number one, the reverse mortgage as a second mortgage. I touched on this a few times. If you've got expenses or you want to fund a business, but you don't want to pay off your low interest rate first mortgage, the reverse as a second is a terrific option. I think I just recently did a video on that. I've got two more going on right now. It's getting really, really popular for folks who understand them. If you want to learn about that or any of these, feel free to comment below or reach out. The hybrid reverse. Okay, so the hybrid reverse is for folks who've been turned down for a traditional reverse because they owe too much money. Again, loan sizes for reverses are based on your age, the home value, and interest rates, and the loan sizes are only so high. So let's say that you owe more, you owe too much on your home to get a reverse. Well, you can try a hybrid. What the hybrid does is you'll have a very low, less than interest only payment for the first 10 years. A lot of cases, hybrids go from people being rejected for a reverse to actually being able to get some cash out. So for 10 years, you're going to pay so you get extra cash. For 10 years, you're going to make a very small mortgage payment, and then it automatically reverts to a reverse. Here's the other thing I'm doing for my clients with hybrid, because everybody wants a reverse. They don't want to make monthly payments. It's just kind of that they have to. So once interest rates drop to a point where we can refi, because remember, when interest rates are high, you get less. When interest rates are low, you get more. So once interest rates do drop, when's that going to happen? Who the heck knows? But when they do drop enough to where we can just refinance you to a traditional reverse, we'll just do that. So maximum, you've got a very low monthly payment for 10 years. Then the automatic reverse, that's the worst case scenario. Best case scenario is that you get some cash, which is what you need. You lower your monthly payment, which is terrific. And then as soon as I can get you into a reverse, we do it. All right. Hope that makes sense. Again, specific questions on that, give me a shout. I've got a couple videos up of that hybrid reverse, but I don't want to spend 3 hours on this webinar, nor do you want me to. Next one, funding your business. Got somebody doing a reverse as a second right now to fund their business, but we also do HECMs. If you're free and clear, you need some cash. You need to basically, whether it's buying equipment or hiring folks, any sort of, if you own a business, you understand what's going on. If you need that and you don't want the cash flow implications, then do a reverse to do it. Pushing back Social Security. This gets into financial planning. So let's say you're 62 and you don't want to take Social Security till you're 70. So you get that 8% annual increase, but you need some help because that Social Security income is what would keep you afloat. Well, you just use your home. So let's say we do monthly income through a reverse for 8 years. That takes you from 62 to 70. You use your house for those 8 years. Then at 70, you turn on Social Security. You're getting more money out of it, and then you turn off the monthly income of the reverse, and you turn it into a line of credit. Pretty neat. If you didn't, you might not know that this stuff is possible. These are very, very, very creative financial tools. Finally, again, there's more examples, but I don't want to go through everything forever. Self-fund your long-term care. Let's say that you can't qualify for life insurance or long-term care insurance, and you just want to create a line of credit that's going to grow, that if you in the future, if you need home health care, if you need long-term care, then you can use that money that's built up in the reverse mortgage line of credit. I'm going to go back real quick and again touch on this. Okay, here's the amortization table. Look at this. If Mike and Ellen were going to use this to fund their long-term care, let's say they had enough money where they didn't need to touch the line of credit, but they had some health issues in their family. Again, look at that. In 10 years, that 360 goes to 720. In 15 years, it goes to 1.132. So you imagine if you have this set up and then 15 years down the line, you need home health care, you have money in your house and it's ready and you don't have to do anything besides take it. And then you're going to age in place and live in your home for the rest of your life. Then you don't have to be like Anne here, who was running out of money and only had 3 months of funds for home health care remaining. You have your funds for home health care remaining. You just take out of the reverse mortgage line of credit. Okay. Hope that makes sense. Again, if you have, oops, I went too far. So, okay. I teased it. We'll talk about the fees in a second. That's what a lot of people want to see. But yeah, if long-term care or home health care is an issue, I have the opportunity with my investors to fast track these reverses. So if this is something that you need right now or in less than 30 days, normally they take about 30-ish days to complete. But if you need money darn near immediately, then reach out and I can give you put you on my fast track plan. Okay, let's talk about reverse mortgage fees. It's a secret, almost a secret. I think I've done a video on this before, but I've done 130 videos. So let's freshen this up for 2023 and 2024. And yes, no reverse mortgage originators like to talk about this, but you're going to see it. So let's go down in the fees. And what I've always felt is if the solution is worth more than the fees, then you do the solution. And if it's not, if the reverse isn't really doing anything for you and you see the fees and you think they're too much, then you don't do it. But either way, you get the information. And again, asking for information is always free. And I'll always do that personally. So how do we figure fees out? Basically, there's two types of reverses. One's a proprietary and one's a HECM. So the HECM has different fees than the proprietary. So HECMs are normally used, well, we'll go into utilization usage later on, but the proprietary, basically the maximum home value for a HECM is $1,089,000 and a couple bucks. So if your house is worth 1.089 million or 3 million, you're getting the same amount of money out of a HECM. Whereas a proprietary, there really is no upper limit. We can lend up to $5 million with proprietaries. So anyway, that's for a different side later on. We're talking about fees. So HECM fees first. They are broken into three parts. Those parts are FHA mortgage insurance, which is 2% of home value, an origination fee, which is $2,500 to $6,000, regulated by the good old government, and third-party fees, which are title fees, recording fees, appraisal, counseling. If you're in a state like Florida or New York or a few others, Maryland, then you'll have a stamp tax or an intangible tax. For the most part, the only out-of-pocket fees that you have with a HECM or a proprietary reverse are the appraisal and counseling. And I can tell you, normally the appraisal is about normally the appraisal is about $650 and the counseling is about $150. Now, if you have a $5 million house in California, yes, they might charge you more for an appraisal. So ask me questions about it, but for the most part, counseling is about $150. The appraisal is about $650, and both of those have to be paid up front. The rest get rolled into the loan. So let's talk about proprietary reverse mortgage fees. With a proprietary reverse, there is no reverse mortgage insurance to the FHA. So let's say your house is worth $1.1 million. 2% of that is 21,000 and some change, $21,786. So with a proprietary, that's $21,000 that's in your pocket instead of the FHA's pocket. That's pretty cool. And by the way, these reverses, proprietary reverses, are still non-recourse. So proprietary origination fees, they're normally about 1 to 3% of the loan amount. They're not that $2,500 to $6,000. So normally the origination fees are a little bit less. And yes, there are still third-party fees, title fees, recording charges. Those are all still charged. Again, proprietaries, even though they're not backed by the FHA, for the proprietary loan to be approved by every state government, to put it another way, every single reverse mortgage has to be non-recourse for it to be a legal reverse mortgage program approved by the federal and state government. So whether they charge the insurance or not, they still have to be non-recourse. Hope that makes sense. If you want clarification, again, give me a shout. Absolutely give me a shout. So let's look at the difference between the HECM and the proprietary reverse. When should you do each? And this is going to be quick, so there might be a scenario where that I'm not touching on here. But when you do the HECM, put it this way, the HECM is very creative. It allows us to put our thinking caps on, and it allows us to mold the program around you, whereas the proprietary really just gives you a lump sum of cash right away. It says, there you go, there's your lump sum of cash. So if you want monthly income, if you want credit line growth, if you want to be creative with it, then the HECM is the way to go. Again, touching on the HECM, if you're free and clear, and let's say you get a $300,000 loan size with the HECM, and you don't have a mortgage to pay off, it's just $300,000. They are only going to give you about 60% of the money up front. So they'll give you about 180 out of that 300 right away, and they'll make you wait a year to get that extra 120. That normally works for most people, but in some cases with home health care or other situations, maybe funding a business, paying off some credit cards, you need the money all up front. So that's when you turn to the proprietary. I put retirement safety net down there, and which is really, for the most part, it's the line of credit that grows tax-free. So the HECM is the only one that does a good job at the line of credit. The proprietary does have a line of credit program, but it's not. I'm not really even touching on it because it's nothing that I'd really recommend too often. It has to be a very, very specific case to do it. So it's not even. Ask me questions on it, and we'll see through your situation if it makes sense. But really, most of the time it doesn't. So that's the HECM. The proprietary. Where does the proprietary hit? If your house is worth, obviously, if you need all the cash at once, do the proprietary. If you've taken out a cash loan on your house within the past year, then the HECM won't let you do it. You have to wait a year from taking out cash to do a HECM. So the proprietary will give you money even if you got a home equity line of credit last week. Obviously, if your house is worth over $1 million, 1.1 million, if it's worth $2, $3, $4, $5, $10 million, and you want to max out the cash, then you got to go proprietary because it's going to give you the most amount of money. Remember, the maximum home value with the HECM is $1.089 million. Okay. So obviously, again, other circumstances, but I want to get you thinking about the HECM versus the proprietary. And here was a recent, I think this was about a month ago, reverse mortgage calculator. I'm coming out with a new one soon. So the HECM has gone up. The HECM has gone up a little bit. The proprietary's gone up a tiny bit, but kind of stayed the same. You can see that the HECM is actually returning more money. I'm sorry, the proprietary reverse mortgage is returning more money than a HECM does. The only thing I'll add is if you get into your late 80s to 90s, that those loan to values kind of switch. And if you're in your 90s, then the HECM is going to return more than the proprietary. But this was for an 82-year-old at a $400, $700 million and $2 million home value. I'm going to move on from this slide, but if you want to take a look at it, just push pause. And again, I'm going to probably next week, I'll give you an updated reverse mortgage calculator here on this channel. So Yeah, this was this was a lot of information. I'm going to do one more example, comparing and contrasting the HECM versus the proprietary, so you kind of see what we're looking at, and then I'm going to finally let you go. Although I'm having fun with this. I hope you're enjoying it. I hope you're learning something. Hoping this isn't too dry. So let's talk about Marge. She's 80. She lives in Malibu. She's drawing down on her assets because I'm using pseudonyms, by the way. Homer and Marge. Oh, I had Homer right there. Look at that. Homer is eating too many donuts. So Homer ate too many donuts and he met his maker. Big heart attack. Sorry, don't eat so many donuts. So Homer left Marge with no life insurance, and her fixed income barely keeps her afloat. She owes $307,000 on the house, and it's worth $1.8 million. Okay. She also, since she's been taking so much money out of her investments, she needs some extra cash to pay her investments back. So she's got the choices, right? She can do either one of them. She can do a regular reverse mortgage, the HECM, or she can do a proprietary. So you can see here at the value of $1.8 million. The HECM fees are somewhere between $26,000 and $27,000. The proprietary reverse fees are under 10. Pretty wild, right? Now, what does Marge get? And this is after paying the $307,000 off. So with the HECM, she's getting 140 with 47 right away, and then the extra 93 or whatever after 1 year. The proprietary, though, is giving her almost $500,000 of cash. You see what I mean when I go back here? If you need all the cash right away, if your home is worth over 1.1, to max the cash out, then you do a proprietary. So now maybe Marge didn't. In this case, hold on, let me get here. So in this case, if Marge didn't, or if you're thinking about yourself, if you don't need all that extra money, if you only need a little bit, then do the HECM and keep the money in the line of credit. But if you need all that money, then take it. It's yours. What if the house was worth 2.8? It would be even more money. It would be like $900-something thousand. All right. Why are the numbers different? We touched on this before, but the proprietary doesn't charge mortgage insurance. It lets her get all her money up front. HECM gives her 47 up front. Remember, 47 up front, 140 total. The HECM is far more flexible. She can take additional funds in the line of credit, monthly sum, income, or any combination. The proprietary only gives you one lump sum. So if Marge said, I only need $300,000, Marge could just take $300,000, but the rest of the money would be lost forever, or unless she wanted to do a new reverse mortgage, which she probably doesn't want to do. All right, let's go back here. Warning on the proprietaries, real quick. So this is, if you're looking into a proprietary, you have to have a broker. Here's the reason why. Look at these scenarios. 3 proprietary lenders out there. There's more, but I'm taking the 3 common ones. One is giving her after closing costs $799, and this is including the 307, by the way. So one is giving a total loan size of $799 after closing costs. One is only giving $710. The other is giving $783. Now, which one are you going to do? You're going to do the one that's $799, of course. But how do you know? And if you go with a broker who only has one proprietary, or God forbid you go with a direct lender who only has their company's proprietary, or maybe they don't have a proprietary, or maybe their company's proprietary isn't in your state. See what I'm saying? You have to go with somebody who can shop these around for you. And of course, I'm saying that because I do. That's how I set up Key Home Lending and Reverse Mortgage Reality, is I work with enough reverse mortgage lenders to where I'm going to get the best for you, no matter what your scenario is. Okay, enough about me selling myself right there. I just wanted to make sure you understood that if you're looking at proprietaries, you do have to shop the different lenders. So, takeaways. This is on the proprietary. It's perfect for seniors with higher home values, right? The interest rate is fixed, no mortgage payments. There is a variable rate option for folks in a few states, but I don't like to touch that. I'm not a fan. And with all of these reverse mortgages, very important, the senior is still, you are still responsible for paying property taxes, homeowners insurance, keeping the home as the primary residence and keeping it up. No, there are not reverse mortgage police that are going to come by the house, but you know, if the roof falls in, then use your homeowner's insurance to get a new roof. Thank you very much. All right, more testimonials. We're done. This is great. I hope you learned something. I hope this helped. Obviously, here we'll go. If you want to see these, this is Elmira and Rita. Rita was a caregiver for a home health care case. Elmira, she just had some bills. We did 2 reverse mortgages together, and she just wanted more money to live a better retirement. She's awesome. She's an ex-police officer, a widow. She's amazing. Teresa, another widow. Wonderful, wonderful, wonderful person. So she was more of in a bind. She owed some money to the IRS, so we used the reverse to take care of it. So different ways to do it. Again, more of the need here. Rita's situation was a need because her client needed money for home health care. Elmira Elmira wanted money. Her son Mark actually introduced Elmira to me too. So it's funny, you find that you might worry about what your kids think about reverses, but for the most part, your kids here, this is how to learn more. This is my contact information. In fact, you know what? Let's go back to me here. There I am. Hi. Hello again. Your kids, about 90% of the time, your kids just want the very best for you. They'll take their inheritance. I mean, when you pass away, if there's money left over, they'll gladly take it. But again, the vast, vast, vast majority of adult children, number one, they recommend reverses for their parents once they understand that they're safe and secure. Number two, they will not take, again, they'll take whatever's left over, but they will absolutely not take mom's money or try to guilt trip mom or dad into not doing something that will help them. You know, they just don't, they're not those type of people. They care about their parents. Their parents have brought them up well. So if you're interested in a reverse and you want to share it with your kids, I'm sure that they will be reasonable. And if not, well, I have other feelings on that. So that's it. That's all I've got. Again, thank you so much for your time and hearing me through this. I really, really appreciate it. If you need help, if you'd like to learn about how a reverse mortgage can help you or a family member or a client, feel free to reach out. My contact information is below. And listen, I'll do my very, 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 very best to help. And the last thing is, again, you know, we've seen it on the slides, but we've got fixed income. We've got investments that have dropped. We have these things that you're not going to have another money tree there. But if you can use your home equity to improve your retirement, man, it will be. I can tell you, again, based on my clients who are now friends, this is going to be a game changer for you. And I'd be very, very, very blessed to help. All right, that's all I've got. Thank you again. If you need me, feel free to reach out or comment below, and take care of yourself.